Good evening, and welcome to the Faculty of Business and Economics at the University of Melbourne. First, I'd like to acknowledge the Wurundjeri, Woiwurrung and Bunurong people of the Kulin Nation, traditional owners of the unceded land on which tonight's lecture is taking place. And I pay my respects to their elders past, present and emerging. We recognize the importance of Indigenous knowledge in the economy. I extend my respect to all Aboriginal and Torres Strait Islander people joining us here tonight. It is my great pleasure to welcome you all to this 2023 public lecture hosted by the Center for Asian Business and Economics at the faculty. It's been a few years since we've had the lecture in person, and the faculty is truly delighted to finally have the opportunity to connect with you all again on campus. Over the past 2 decades, China has been Australia's largest trading partner in a rapidly growing global economy. But just as the pandemic reshaped global work patterns, there has been a noticeable economic slowdown in China, affecting demand for Australian exports. India, on the other hand, is emerging as a significant trade partner in the region. Reflecting on these evolving trade dynamics, tonight's public lecture on China and India, Our Journey Ahead, presented by Richard Yetsenga, ANZ Group Chief Economist, holds exceptional relevance. I would now like to invite my colleague, Professor Helen Hu, Director of the Center for Asian Business and Economics, to formally introduce our distinguished speaker. Thank you and welcome to this event.
Thank you, Paul. Good evening, ladies and gentlemen. It's my great honor to introduce tonight's speaker, Mr. Richard Yetsenga. Richard serves as the Chief Economist and Head of Research at ANZ Group. In his role, he leads the bank's global research team, focusing on Australia, New Zealand, and Asia. Before joining ANZ, Richard worked as the Managing Director of Emerging Market Strategy at HSBC in Hong Kong. Before his time at HSBC, he held economic positions at Deutsche Bank and the Australian government. Richard is passionate about writing on diverse economic topics, including climate change, technology, inequality, and the benefits of diversity. Under his leadership, the ANZ research team has received over 40 top 3 rankings in major industry surveys across Australia, New Zealand, and Asia in the last 6 years. In addition, they've earned many prestigious industry awards. Richard's expertise is highly sought after, both internationally and nationally. He is a regular commentator on CNBC, Bloomberg, and various regional media outlets. And with his interest in the interconnected nature of the world across business, economics, technology, and society, Richard's work has also been featured in publications globally, including the Wall Street Journal, Hong Kong's Economic Journal, Singapore's The Business Times, Japan's Nikkei, as well as leading local outlets, such as the Australian Financial Review, the Lowy Interpreter, and The Australian. We are excited to have Richard here sharing his insights into the evolving economic dynamics of China and India and their implications for the global landscape. Tonight's lecture is being recorded, and the recording will be available on our faculty website. Following the presentation, there will be an opportunity for audience questions. Richard, we are honored that you have given us your time tonight to share your wealth of knowledge. So, without further ado, I hand over to you.
Thank you very much. Thank you, Paul. Thank you, Helen. And thank you, Vanita, for pulling the event together. And obviously, thank you to the Faculty of Business and Economics for the opportunity to share, to talk about what I love, which is anything to do with economics in reality. Can I Maybe start with a little sense of where the audience is at. If you've travelled to China, and I mean just ever, can you put your hand up? A lot. Okay, hands down, class. If you've travelled to India ever, can you put your hand up? Yeah, I think maybe about a third as much is what I would probably guess. Incidentally, I've been to two places. I've been very fortunate to travel a lot. I've been to two places that I've been to where I've got off the plane and rung my wife and said, you absolutely have to come, and India was one. So if you've been to China and been to India, you've been to a great country, but you need to go west and have a look. It's amazing. I'm a bank economist, not an academic one, not a government one, so I bring a kind of my lens to the topic at hand. If you have a different perspective, I'd love to hear about it through Q&A rather than through fruit or other projectiles. And by the same token, if I say something in the presentation and look, it doesn't really resonate, you don't get it, I use language you don't understand, I'm happy to cover that off as we go along. Still no projectiles if you can deal with it though. China entered the World Trade Organization in 2001. Australia's prosperity, the region's prosperity, and in fact the global economy has been intimately tied to China in the 20 years since that period. In my view though, this kind of age of China's economic exceptionalism is over. The China of the next few years and decades, I think, is going to be remarkably different from what we've experienced the last couple of decades. And this transition is not because of something that's happened in kind of now, in the short term. I think it's because of three quite long-lived trends that are coalescing together around the same time. It doesn't leave China as a weak economy or any less relevant or any less large in terms of its impact on Australia and the region, but it does leave it growing much more slowly. My kind of presumption is China will probably be growing at rates more like 3 and 4% a year than the 6, 7, 8, 9% numbers that we've been used to. This is a chart of China's CPI. Something different is happening in China. Brief periods of deflation are not unusual. There have been a few episodes in the last 20 years, the Asian crisis, the GFC, the COVID pandemic. What sets the current period apart is China's dealing with a deflation challenge while the rest of the world is dealing with an inflation challenge. All the other periods of deflation in China, it was a common global problem at the same time. Maybe not every economy was suffering outright declines in prices, but everybody had a lowflation challenge while China had a deflation problem. It's very clear that whatever's going on in China is unique to China and not driven by global events. There's lots of people writing. There won't be a test later, just so you know. China's status in the global economy is unarguable. This is the world's second largest economy at current exchange rates, the world's largest economy at purchasing power parity exchange rates, the world's largest trading nation, the single largest contributor to the reduction in inequality in recent decades. Since 1978, the IMF says China has lifted 800 million people out of extreme poverty and accounted for nearly 3/4 of the global reduction in extreme poverty. China's economic track record speaks for itself. And all this has occurred with a trend to declining rates of economic growth in the last 15 years. The pandemic has been associated with even slower growth, but the trend was well in place before then. So it's not something which has occurred recently. It hasn't been caused necessarily by the pandemic in large part. And equally, there is nothing unusual about this progression to slower economic growth. In 2014, Larry Summers published what for me was an extremely impactful piece of research looking at 100 economies across more than 50 years of economic data. And his intent was to look at history to understand what he called the fourth stage of the Asian story, the rise of India and China, and understand with a bit more rigour what might transpire. He uses language on the screen that's a bit technical, but the message is pretty clear. Countries that grow quickly do not do so forever. In fact, the single most pervasive feature of the data is that fast-growing countries always slow. They come back to the mean. And in fact, just because you are growing fast today really doesn't tell us anything about whether you will be growing fast tomorrow. This chart presents data on China's economic growth over the last few decades, along with its progression up the GDP per capita scale. So the GDP per capita scale is on the bottom axis, economic growth on the vertical axis. Wealthy economies usually get wealthy by growing for long periods of time, not because they grow particularly quickly. And they bounce back well from crises. To quote Larry Summers again in the title, the leading countries have very stable growth rates for a very long period of time. It's not possible to identify with any sort of precision when an economy might move from being fast-growing to growing more slowly, but certainly as GDP per capita rises, as you move along the horizontal axis, the opportunity for additional fast economic growth diminishes. The World Bank puts the top of the middle income range at $13,800 US per capita. China is at 12,500. It's an upper middle income economy. You can see economic growth in the US has tended to slow as it's become wealthier. Instead of the US, I could use Korea, Singapore, Japan, a range of other economies, and the message would be almost identical. With greater wealth comes slower economic growth. I've used the US for two reasons. One, because it gets us away from the Japan comparison and the inevitable discussion about why China may or may not be like Japan. And the second reason is because the US is the economy most comparable in size to China, and I'll return to that issue later. If you look at the data for the US, growth in the 1950s was slower than the 40s, in the 70s slower than the 60s, in the 2000s slower than the 1990s. The US has crises too, but it also bounces back quite well. All countries are, of course, different in some ways. Russia was held up as a growth model for a while, so was Japan. The East Asian tigers themselves rewrote, in many ways, the history of economic growth and what we understand about what drives economies. They all grew quickly and then they all grew slowly at different points for different reasons, but the transition from one regime to another was some way inevitable. And China is its own economic story. It's not the same as the others. The key question in this context, though, is are there differences in the most fundamental drivers of economic growth in China that mean China's growth can be sustained for even longer? And I think the answer is no. And let's start with one of the two, in my view, fundamental drivers of economic growth: credit. The Bank for International Settlements put China's debt at 304% of GDP. There are other economies with similar levels of debt. All of them grow slowly. Comparing China with other economies with similar levels of household debt, the other two grow slowly. China's domestic debt situation, to me, doesn't suggest we should expect China to be particularly different from economies that have been through this growth transition before. I don't have any reason to expect any sort of acute crisis, and you won't hear me use the crisis word, but I do think it suggests slower growth. Debt is about the stock of financial liabilities in the economy. The flow of money in the economy is what adds or detracts from that stock over time. This chart looks at the growth in money supply compared with the growth in nominal GDP across a range of economies over a 14-year period. I can run this chart back further in time and use longer averages. I can introduce more countries and make it difficult to identify which dot belongs to which economy. But the message is identical. Fast nominal GDP growth is always associated with fast money supply growth. If you structurally lower the flow of credit, you will almost certainly structurally lower nominal GDP growth. Credit facilitates activity in modern economies. Economic history says the lifeblood is crucial. There is no example of an economy that's had an impaired credit creation mechanism that's also grown quickly at the same time. If you find one, can you let me know? So I'll be able to say there's maybe one. I think in China, as it tries to limit the growth in debt, it must inevitably limit the growth in nominal GDP. I think the second major driver of economic growth is us, people. China is quite unique in terms of its demographic situation. If you just read the screen, the age pyramid has a bulge at the top and fewer people at the bottom. The number of women in their 20s is declining sharply. There's a gender skew in favour of men. The result is the population is now falling, and a trend that is almost certainly entrenched. And the United Nations projects population ageing, which in many ways is difficult to comprehend. 41% of the population over 65 by the end of the century. It's worth just dwelling on this slide for a few minutes and thinking it through carefully, I think. Less producers and more consumers in a quite early stage pension system. I think population is integral to economic performance. You want one example? Australia today. I mean, it causes other problems, those of you who aren't house owners. Let me talk about a historical example, and it's slightly esoteric, but I like it because it makes the point extremely clearly and makes the point for long periods of time. On the screen is the story of England and Wales compared to France over 200 years. The top chart, fertility in France declined sharply, diverging from England's, and previous population trends changed very sharply. And the shifts were enormous, actually. France had a population 5 times larger than that of England and Wales in the 1700s, but today the populations are not far apart. Huge demographic shift. But look at the bottom chart. GDP per capita did not diverge very much between the two economies. By 1750, England and Wales had caught up, and from there both countries saw GDP per capita evolve largely one for one. In other words, all the shift in population flowed through to the level of GDP, not to living standards. I would expect China to keep improving its living standards, to keep raising GDP per capita, but the decline in the number of people is just going to make it much more difficult to grow GDP in the way we're used to. There's still people writing, there's not going to be a test, just so you know. One common suggestion I receive is that despite its demographic trends, China can still urbanise. Shift a resident from a less developed part of the country to a more developed part, contribute to urban agglomeration. Typically they work with better capital equipment, better technology, surrounded by more capable and more educated people, and the economy grows as a consequence. That's true. When the population is rising, it's kind of a win-win. The city that exports the people doesn't seem to lose very much, and the cities that import the people clearly benefit. But what about when the population's falling? For the cities that are exporting the workers, who pays the taxes? Who lives in the dwellings? Who does the entry-level jobs that young people typically do? Of the 95 cities we track in China, 40% now have declining populations. And remember, China's aggregate population only started to decline last year. Detroit's economy was pretty challenged when population exited. Earlier I compared the US and China, well, related the two because of the scale aspect, and I just want to return to that point. China has an additional growth constraint that small economies don't. It has an additional growth constraint that is similar to the US. It can't export its way to prosperity. Who is the largest economy in the world going to export to? You can't copy Singapore's model or Korea's model. If there's a model, actually, it's the US model. China's share of global exports is now similar to where the US was in the 1970s, when it was still coming down from its dominance of global activity after the Second World War. The US accounted for about a third of global exports at the end of the Second World War. And you can see that trend has continued to decline today. As the US has developed, it's become more consumption driven. It's imported more rather than exported more. For China to become the world's largest economy or close to it, the world's largest trading nation, and be the world's largest current account surplus economy would imply a further large-scale global shift in export capability from other countries to China from where we are today. And other countries have obviously already given up export capability. That would seem to me to be a low probability outcome. There must be a transition to domestic demand as a source of growth. I don't view this as a policy choice or an economic choice. I view it as a natural consequence of China's size and its continuing economic development. But how likely is it, as China moves to domestic consumption, that consumers that are almost as indebted as those in Japan or the US will continue to drive the economy at the rates of growth that we've seen historically? That also would strike me as a low probability outcome. Let me wrap up a little bit on China before I turn to India. I think China's economic transformation in the last 20 years has been remarkable. Every time we see a new economic story, we rewrite the history of economic growth, and China unambiguously has done that. None of that is in question, but the economy is changing, and I think slower growth is really an inevitable consequence, and the nature of demand, I think, will shift as a consequence of that. China, we should expect to progressively consume fewer early-stage commodities. An economy with a falling population should naturally consume less steel and cement, probably consumes more renewable energy. Medical care and retirement services clearly in growing demand. Education services less than has been the case historically. Some of these changes are even happening quickly. Sinopec recently, for instance, suggested gasoline demand in China would peak 2 years ahead of schedule. China obviously has market-leading positions in a range of sustainability-related sectors: wind turbines, electric vehicle batteries, and solar modules. I think these new areas of activity and trade will become more important over time. India is not China, but beyond population, actually there's little to compare the two economies. But China has been, if you like, the big thing, and I think India offers some potential for at least something that is, if not directly comparable, in the same ballpark to occur in terms of scale and how it impacts the global economy. When we talk about India in this context, it has a challenge that China didn't. It has China. China's explosion to global dominance naturally resulted in comparisons with India. Why can't the other Asian giant do as well as the North Asian giant? China's GDP growth outperformed India's in all but a handful of years over the last 30 years. India didn't perform terribly in its own right. There are many economies in other parts of the world, in Africa or Latin America, that would welcome average GDP growth of 5%. But for an economy that seemed to offer this natural comparison to China from a population and potential scale perspective, there's, I guess, what I call a disappointed legacy of expectation for India. This constant sense it hasn't quite delivered. But I want to talk about three things. One is China has changed, and I think that does affect the rest of the region, but maybe not in the way you think. Secondly, India has changed. And the third issue is let's use the right yardstick. And let me talk about China first. China has dominated the regional and global narrative for the best part of 20 years, this kind of age of China's economic exceptionalism, to use the phraseology I referred to earlier. And as a result, what has been transpiring in China is integral to the rest of the region, because I think the slowdown has other implications. If you ask economists what China's structurally slower growth means to the region, I suspect where they will start is, well, lower export demand for the other economies. It's probably true. Maybe different is what I would say rather than lower. But there's an offset to that. China has been magnetic to capital and expertise the last 20 years. If you were going to be in Asia, you just had to be in China. The export potential was too high and the domestic consumption potential was too high. There was no other market that offered you anything close to both of those attributes. Half of the region's foreign direct investment went to China in the last 20 years. Expats and expertise naturally was associated with that. As China has begun to open its investment markets to foreign capital, you can see since 2018, 75% of regional portfolio flows have gone into China. Any other economy in the region had to compete against that. And some succeeded, there's no question about that. Singapore had very deliberate strategies around parts of the financial sector, around pharmaceuticals, for instance. And in true Singapore style, when it sets its mind to something, Singapore usually does very well. Vietnam, a very deliberate strategy around manufacturing and attracting foreign direct investment. Very well structured plan, a whole of government approach, did very well. But most of the rest of the region has found it very challenging. Cost advantages weren't sufficient. You needed a plan. You needed to compete with the China story. But I think you can already see in the flows that the changes in China are meaning that people are looking for alternatives. Portfolio capital outflows from China last year, and let's remember it was a difficult year for interest rates globally. Portfolio capital outflows from China were more than 4 times larger than from India last year. Foreign direct investment into China fell to the lowest level since 2016. Into India, it has remained strong over the entire pandemic period. Last year, the value of cross-border M&A deals declined in almost all economies in the region, except in India, where we hit a new record. Even in Japan, has surpassed China as a driver of investment banks' equity revenues this year for the first time since 1999. The actors that move most quickly are shifting already. Sometimes the journey becomes clearer when you look backwards and realise how far you've come. And with India, more than any other economy, sometimes I do find people need reminding of what has changed and how much improved things already are. Admittedly, this is a slide of anecdotes and kind of factoids. Electrification, transport, infrastructure, the transformative impact of the GST, the boom in air travel, there are many others I could have chosen, but they give a sense of the narrative and they're kind of breadcrumbs, I suppose. so we can look at a comprehensive picture and think, well, what might have happened on the ground to drive this? Let's look at one measure, fiscal spending on infrastructure. The World Bank, or the IMF, sorry, labelled India having world-class public digital infrastructure. And India is clearly moving on its physical infrastructure to try and close that gap. State government infrastructure spending is now 23% of state government investment spending. It's never been higher than that. At the central government level, infrastructure spending is 19% of capital spending. It's never been higher than that. When the rest of you go to India, you can't help but notice how aggressive the infrastructure spend is across all different parts of the economy. The most recent government budget actually doubled down on the infrastructure agenda and is increasing capex spending to 4% of GDP. Let's widen the lens a little bit further though, and not just look at infrastructure spending, but look at capital investment across the entire economy for the private and public sector. You'll often hear people say India doesn't invest, it underinvests. It doesn't invest at the same rate as other Asian economies. It will never be able to develop properly if it doesn't invest. That was true, but it's no longer true. At 35% of GDP, India invests, you can see, much more than it used to. It invests more than any other economy in the region with the exception of China, which it shouldn't want to emulate given the overinvestment challenges China has. And it's the only economy in the region to have higher capex spending post-pandemic than the pre-pandemic average. Similarly, on trade, there are trends in India which have changed substantially that are regathering steam more recently, and I don't think they're changes which are generally recognised very well. If I can recommend a book on India, Andrew Charlton's written a really interesting read, fellow economist, member for Parramatta, for those of you who don't know, on Australia's relationship with India over the last few decades. And just, can I quote Andrew for a minute? As two former colonies, our economies, India and Australia's, our economies have been shaped in ways that reduce our industrial complementarity and reduce mutual trade. And for India, one of the things that was altered was largely an absence of trade with Australia or anybody else. While we've been focused on China and its export prowess, something remarkable has happened to Indian trade as well. As the share of GDP, trade in India is now five times larger than it was 4 decades ago and is comparable with other large economies like China. Australia is a medium-sized open economy. We trade, that's what we do. A fundamental precondition of economic engagement between Australia and any other country is that we do some business together. And the scale of opportunity in India is now there in a way it hasn't been before. Beyond that though, and this is a chart I used earlier, but I've added India to the bottom of the chart. India's international trade presence offers plenty of upside. India accounts for about 2.5% of global trade. 5th largest economy in the world, 2.5% of global trade. I think as India's economy scales, its share of global trade is going to scale as well. I mentioned 3 issues around contemporary India, that China has changed, that India has changed, and using the right yardstick. Let me talk about the yardstick as my last point. India's GDP per capita is about $2,500 US. China's is $12,500 US, 5 times higher. Australia's is $60,000 US, more than 20 times higher. And yet, I often hear people use their domestic frame when they talk about India more than for any other economy. India is at the lower end of the middle income range. It's where China was 2 or 3 decades ago. A developing economy is going to have problems. It's going to have warts. It's going to have challenges. We should expect an economy at India's stage of development to have a long to-do list. It's the to-dos that give the upside and the to-dos that give the development path. What matters is not the length of the list, but whether you're ticking things off in the trajectory of performance. On one measure, the World Bank's Doing Business survey, India has been outperforming, and in many ways spectacularly so. This survey has I'll call it a checkered reputation, so I don't like to dwell on the exact numeracy of the numbers too much, but the message is stark enough. I think we can still take it as valid. China was well into its middle income phase before it meaningfully shifted into the top 80 economies in the world in terms of ease of doing business. India has done that in the last couple of years at a much earlier stage of development. You can see much earlier stage of development. So I just want to encourage you, and when you hear people talk about India, just try and get them to be contemporary in the way they frame the Indian economy and the Indian development story, and they're thinking about it from the perspective of an economy that has a standard of living that's more than 20 times lower than Australia's. I'm happy to leave these QR codes up on the screen during the Q&A. One will take you to our 5 in 5 podcast. I hear it's quite good listening with the kids over breakfast. I can't validate that myself, but you could try it. The other one is to subscribe to our research. Just as a disclaimer, we do have regulatory requirements around who can receive our research, so that if that is not you, please don't take it personally. Let me make a few closing comments and I'm happy to take Q&A. Hindsight's a wonderful forecaster. You know, China's performance over the last 2 decades is now treated as something that was transparently predictable, but for those of you who were around at the time, it was anything but. As China has slowed, many have been taken by surprise. Many, in fact, expected China to be the world's largest economy by now, and yet it's not clear that will happen on any time horizon. China is still 25% smaller than the US. Others have spent time predicting China's collapse, and neither set of forecasts have been on the mark. And I think correspondingly, India's journey needs to be assessed on its own merits. Economic development has no standard recipe. The Asian tigers were unique in the way they developed and their economies performed. China's rise has been unique, and I think India's rise will be unique as well. Thank you very much. Thank you, Helen.
Thank you, Richard, for your engaging and insightful discussion. I'm sure the audience will agree with me that we are gaining deep insights into the economic and the global landscapes of China and India, exploring their past, understanding their present, and envisioning their future. With such an important topic, I now invite the audience to ask questions. There are 2 microphones because we are recording. So if you have a question, please raise your hand and wait for the microphone to be brought to you before speaking. We try to get through as many questions as possible. Who wants to go first?
It's not looking like a big problem at the moment, Helen. 10 seconds of bravery. Thank you very much.
Over there? Yeah, a gentleman at the back.
Thank you for a fascinating discourse. Unique is a very difficult word, and you described China's growth path as unique. You also very early on discounted the comparison between China and Japan for, I think, fairly clear reasons, and chose to compare it to the United States because of the size of the 2 economies. I think it at least is arguable that China's growth path has paralleled Japan's very closely in terms of a catch-up economy with a very high level of export-led growth, followed by a subsequent over-asset inflation period, a demography which turned negative in China's case at a much earlier stage in its overall economic development than Japan. The difference with the United States being, of course, that its demography, its population continues to grow. I think another fascinating dimension is social security policies. And to my mind, if you look at the three economies that you mentioned, all of them have relatively underdeveloped social security systems relative to higher income economies. And I wonder to what extent that adds then to household debt. Now that's an aside and a speculation. Now what's my question?
That's a good question.
Yeah. Well, in that case, that's a good point to leave it.
Thank you for the not question. We appreciate that. Yeah.
I'm Laura. Thank you, Richard, for putting on such a... it is a feast about the information that we need to know and we didn't. So thank you so much, Richard. Can I ask you a question, probably Curly? We all know how successful China has been, and China benefited itself over the past 30 years for opening up to the world, but also likewise the world has been too, through its rising of prosperity. If I give you a crystal ball, can you tell us what the world looked like on economic prosperity perspective out of the US and China and India in 30 years' time? Thank you.
How many years?
30.
30. Look, perhaps from an economic perspective, the two biggest global shifts that we can identify that seem to have some permanence, in my view, are the climate transition and the shift around liberalised trade. You know, I think with hindsight, we pursued trade liberalisation on a global basis with the view that it would raise living standards, which turned out to be absolutely right, but we focused too little on the distribution of where those living standard improvements would flow to, and the result is we've seen some blowback away from that. The way the world is developing, that now seems entrenched. So these three big economies are all developing in a world which is fundamentally different from a trade perspective. And they're developing in a world which is fundamentally different from a climate perspective. So often I get asked about India's demand for commodities. You know, it would be almost impossible, you would think, for China, for India, for us to look backwards and say India consumed as many commodities in China. Commodities now have a climate price attached to them, or increasingly will have a climate price attached to them. The US has a big advantage over the other two. Its population is a third or a quarter of the size. I mean, 300 and something million people, it's still ginormous. And that means that immigration remains a source of demographic lengthening, which I think is an enormous advantage for the US. The US to the first question, the US does have an advantage, I think, in top-line economic performance because of the way it treats social security. It's not a model I don't know that other countries should aspire to it, but it's the reality of the US, and it means they tend to bounce back from crises very aggressively, and I think you do have a very industrious economy which delivers a lot of economic performance. So I think the biggest shift will be between India and China, where India will catch up enormously, I think. China will still grow, but there's no reason India can't compound at 7% a year in real terms. Those of you who are good at compound maths, 7% a year in real terms, it doubles every decade. It's a $4 trillion economy today. China's a $5 trillion economy and not really changing. You know, it won't be too long before India's the third largest economy in the world, I think.
Good. There.
Thank you, Richard, for a very interesting presentation. The first question I had is, you touched on the China's debt. Now, America too has a very large debt. How different are the two, and why do you consider China's debt being an issue, but not in terms of America's debt?
Look at that.
A second question, if I may. When it comes to, you've touched on China and India individually, but together as BRICS, could you share your views on the cooperation between the two and how that might affect these countries? Thank you.
Thank you very much. They're good questions. The second one, honestly, I don't have a lot to say. I probably think less about what countries say about the way they interact, and I observe the way they interact. And India does seem, at the moment, to be the country everybody wants to be on friendly terms with. So it's not obvious to me one country gets a benefit out of that except India. On the debt issue, and I've just put up the household debt chart again, and you're right, from a public debt perspective and a household perspective, the US is a very indebted economy. Trend growth in the US is about 2%. Yeah. Look, I worry about the US fiscal situation, as I think everybody should. One of the credit rating agencies has taken the US off AAA down to AA. Another one of them recently, I think, revised their outlook from stable to negative. I think they're appropriate shifts. If you looked at the US today, it has an incumbency advantage, but it doesn't present the metrics you'd expect from a genuine AAA sovereign credit any longer.
Gentleman here, then the lady next.
Thanks very much. China's trajectory towards a lower growth economy, is that still based on the assumption that they will successfully transition to more of a consumption-led model rather than investment-led? And if they continue to fight that transition and focus on an investment-led model, does that mean China will be more likely to actually stagnate in the coming decades?
That's a very good question. I'm not sure there's a lot of choice about that transition. To be an investment-led economy, you need funding. There's no investment without funding. Well, I mean, there are some examples. Apple has an ROE of 40% or 60% or something. It throws off enough cash, it self-funds its investment. That's a rare example, though. From an economic perspective, economies that invest a lot borrow a lot. That's why often there's a lot of synchronicity between fast-growing economies and high credit growth, because they're kind of different sides of the same coin. When debt's at 304% of GDP, I just don't see where the pool of credit will be that would allow you to pursue the investment-led cycle any longer. I just think that will naturally run out of steam. For China to continue to develop from a per capita GDP perspective, I think it must transition to the consumption-led model. The question is, how quickly can it grow under that model?
Thanks. So I have two questions. The first is regarding Chinese, there has been a lot of discussion around China becoming uninvestable for foreign capital. And indeed, we've seen, despite multiple rounds of policy stimulus recently in China, and the Chinese stock being very cheap in terms of valuation perspective, we still see large persistent outflow of foreign investment. So my first question would be, do you see this capital flow out of China kind of a persistent structural change going forward, or is it more of a temporary investors reassessing the risk associated with Chinese market? And my second question is, I think it's also related to the risk perspective in terms of investment in China. It's more about, so in terms of geopolitical risk, there has been a lot of concerns from foreign investors around increased geopolitical risk associated with the investment in China. So my question would be, do you from your perspective, do you see geopolitical risk as a material risk that will keep impact the global sentiment, or do you see that geopolitical risk as something that could be diversified away for investors? Thank you.
Thank you very much. Maybe I'll take the geopolitical issue first. We live in a more fractious world from a geopolitical perspective. I don't think that's an issue about investment in one economy. I think it's an issue that any cross-border investor needs to grapple with. In fact, it's an issue that any business that operates either within one country or across borders needs to grapple with, because even if you operate only domestically, you must inevitably have supply chains somewhere in your business structure which reach offshore. We have to deal with that. Businesses have to deal with that. I don't think it's a one-country issue. It's a global issue and a change in the landscape. On the capital flow piece, I think the adjustment in expectations, I think, has been quite meaningful. So this could go on for a while. But Japan doesn't really grow, and yet it gets lots of foreign investment at different times. Yeah, I just think this, I use this phraseology of the age of economic exceptionalism. I think there was a sense that, China was going to go up forever. The economy would always grow very quickly. The markets would always get bigger. There would always be another opportunity. And part of that was reflected in the flows that had gone in, and that change trajectory, I just think, needs to get repriced into where the flows are. Yeah. China took 3/4 of regional portfolio flows. It doesn't seem like the right number. Yeah.
We have time for 2 more questions, one here and then one over there.
Thank you very much, Richard, for the spectacular presentation. I just wanted to ask you the question about how much are the economies of these countries, India and China and Australia, interconnected, and dependent on each other? And what does the contained growth of China and India really mean for Australia?
Australia and China, I'll try and answer more than 2, so
okay,
I'll go very quickly.
Yeah.
Australia and China are obviously much more connected than Australia and India because there's been this incredible Chinese economic story. In fact, most economies in the world have China as their largest or second largest trading partner. So China is very connected in the global economy. How did that process happen? A lot of you will remember the mining boom. Some parts of the economy had to shrink to free up resources for the parts of the economy that benefited from China's emergence. This is not about China's decline, it's about growing more slowly. So to the extent those sectors free up resources, they'll be able to point to other parts of the economy. This lady's been very patient.
Thanks so much for the bonus question. Just wondering, how would you compare China's economic development to that of Soviet Union during the Cold War, based on its increasing nationalization, increasing decoupling with the Western world? Because so far our prediction and comparison has been based on the fact that we assume China's economy is a modern capitalist economy, and we're leaving the political aspect
economy.
aside. Yeah.
Honestly, I don't think about that very much. The data says there hasn't been that much decoupling, actually. It's very hard to identify any global trade decoupling, whether it's for China or for any other economy. So perhaps at the margin in some narrow sectors, the world trade system operates differently, but so far I still view the world as globalised. And in fact, global trade as a share of GDP, it's been roughly stable since the global financial crisis. I think that will probably stay there. Do we have other hands up? Yes. All the shy people. Yeah, okay, great.
Thank you, Richard. My name's Marla Thiagaraj, and I'm the Director of Major Initiatives, Partnerships and Government for the Faculty of Medicine, Dentistry and Health Sciences, and I oversee the international portfolio. Thank you for your talk. It's been illuminating. One of the things that the University of Melbourne is doing, we will be releasing the Advancing Melbourne Globally strategy by the end of the year that's being implemented by our DVC of International, Professor Michael Wesley. And one of the things that we're looking at the Faculty of Medicine, and I have my international manager beside me, is expanding not only collaborations in both India and China, but also student recruitment. And there's an active strategy to basically triple our international student recruitment from China, India, and also Indonesia. And so I guess to get to the point about the question for India, one of the things that's been noticeable, I've been in the role for 2.5 years and I was at Monash for a long time, was that the University of Melbourne has not actively fostered that relationship with India, but there will be a global hub opened in India next year. And in terms of the advice you would give to the university about where it should be focusing its efforts, so Indians traditionally have sent their, say, the middle class students to the US and Canada to study medicine and clinical sciences, and they haven't seen Australia, if I'm being frank, as a country of opportunity. There's a whole legacy of the White Australia policy that I won't even get into about why middle-class Indians wouldn't necessarily send their students or children here to study, but that's changing. And the Indian diaspora in Melbourne now is over 700,000, so it's the largest diaspora and has actually overtaken the Chinese community as opposed to Sydney for Victoria. So in terms of where the focus should be for the University of Melbourne, Australia's got extreme workforce shortages. It's got the lowest productivity levels since World War II, and the Australian government is looking at ways to increase productivity. But to be honest, we've got an ageing population and we need to look at overseas labour markets, be it China and India. So we've got shortage of engineers, healthcare professionals. What areas would you see as, I'm sorry, I'll get to the point.
No, I know there's a question in there somewhere.
Areas that you would see for great collaboration for higher education, because Jason Clare published their higher education strategy for India in the last week.
Yeah, I'm not an expert, honestly. I would recommend you speak to Jodie Mackay at the Business Council of Australia. She's done great work on India. She knows the country inside out, back to front. She would have thought about higher education. Jodie, I hope that's okay that I say that, but if you need her contact details, let me know.
Great, thank you.
I think, do you still want to take one?
I'm okay.
Question?
2 more questions.
Okay, 2 more questions. One lady here and a gentleman over there at the back.
See if you can...
Hi, Richard. My question is less academic, but it's one that I'm always curious about. So I am Chinese. I only left China like 1 month ago. So you mentioned there is a deflation in China, but from what I experienced in China, things are getting more expensive and living costs are just rising all the time. So I wonder if there is a reason from an economic perspective why people are experiencing things differently than the theory.
That's a great question. I mean, the CPI data, I guess, is not, it's not, oh, they've turned me off. We've run out of power? No? The CPI data is not really theory, it's just, it's a measurement. Of course, it's imprecise, and for an economy as large and diverse as China, and I don't know where you were, there may, of course, be differences in the way prices behave. Yes. And this is measuring changes in prices. So you may identify that price levels are very high, but this shows actually they're not moving very much, rather than the fact that they might not be increasing as much as before. China's major cities, though, do strike you as quite expensive, as Australia's major cities are.
Okay, thank you.
Thank you.
Our lucky last.
Thank you so much for that, Richard. Can you hear me? I'll keep my question very brief. So again, just wanted to understand your opinion about China's focus on real estate and them still pivoting to the housing market. In the longer term, do you think that the housing activity will rebound? Thank you.
Look, the challenge around the housing sector will come to an end. The extreme example is Japan. In Japan, it came to an end. Of course, it came to an end in an economy that was behaving very differently from kind of when house prices were going up. I don't think we'll see the same in China, but I certainly think when it comes to an end, which will take a reasonable period of time, it will come to an end in an economy that looks looks quite different. And you know, the issue about a debt is a difficult one because my first visit to China since the pandemic was last month. And I talk about some of these issues, and there are some good sectoral stories which seem to buck this trend. You know, what about EVs? What about the fact China produces 86% of solar supply? What about the battery story? What about critical minerals processing? A range of kind of other apparent opportunities and sectors. And I don't disagree. China seems to have good strategies in all of those sectors. They seem to be doing very well. But where will the funding come from? Because if the financial system has provided funding to the local government sector and the property sector, and that's what they're needing to digest now and work through, typically the credit system will start to reduce its appetite to lend even to particularly good credits. That's what happened to advanced economies in the middle of the GFC. That's an extreme example. But when banks start to feel a bit encumbered with some of the loans they've made, they become hesitant to lend even to entities that should in fact get credit. So it's not Japan, except to the extent that we'll get through this period, it will be an adjustment, and the economy that comes out the other side, I think, will be quite different. We over? Thank you.
We're over. Thank you, Richard. And thank you, everyone, for your engaging questions. Now, I'd like to invite Mr. Muan Ling, Chair of the Center for Asian Business and Economics, to deliver the concluding remarks.
Thank you, Helen. Richard, on behalf of the University of Melbourne, I extend our heartfelt gratitude for your enlightening public lecture. It's good to hear from a non-academic economist. Your comprehensive analysis of economic trajectories of China and India and the implications for the global and Australian economies provided us with many valuable insights. The nuanced perspective of the shifts in China's economic fundamentals and the end of what you put as the era of economic exceptionalism offered a very thought-provoking understanding of current global economic and geopolitical dynamics. Equally captivating was your portrayal of India's emerging economic landscape, especially its advancement in public digital infrastructure compared to China, which spends much more time on its physical infrastructure, was particularly enlightening. It's intriguing to consider India's potential role in reshaping the region and the global economic order. This lecture has not only broadened our understanding, but also sparked meaningful conversations on the future of the Asian economy and its global impact, especially in these uncertain times. We are very grateful for the opportunity to learn from your expertise and look forward to future collaboration with your good self and, of course, ANZ, which is a very good supporter of our faculty and our students. Please accept a small token of appreciation on behalf from the Faculty of Business and Economics, and thank you once again for a truly enlightening and thought-provoking evening.
Thank you very much.
Thank you, Richard.
Thank you. Thank you very much
for coming all the way from Sydney.
No, welcome. Thank you very much. Thank you, everybody. I noticed you wrote those comments before I gave the talk, but